When purchasing a home, it should come as no surprise that more than 90% of borrowers need to fund their purchase with a loan. But what type of loan should they choose? There are literally hundreds of different types of loans. A good analogy might be automobile shopping. When you search for a car, truck, or SUV, there are lots of options with different features available. Some might cost more money today, but have the potential savings down the road. Loans are very similar in that you need to think about the future to determine which loan is best. An inexpensive loan today might become expensive tomorrow if the interest rate can be adjusted upwards. The most common loan today is the long-term fixed-rate loan, with the 15-year and the 30-year being the most popular. These loans are usually fully amortized, which is just a fancy way of saying that at the end of the time period you choose, there is a zero loan balance. In fact, the word amortized literally means to kill off slowly. Over time, part of your payment goes towards the principal, while a larger part goes to interest. As you continue making payments, a larger portion of the payment goes towards the principal until you get to that final payment, resulting in a zero balance. The payment amount remains constant over time unless taxes or insurance are withheld as part of your standard monthly payment. The main benefit of a fixed-rate loan is obviously the stability of the payment amount. The key drawback is with a longer term, the borrower who keeps the loan for the full term pays a lot of interest. Interest rates fluctuate daily, but for demonstration purposes, let's look at a 30-year fixed-rate loan of $200,000 at an interest rate of 7%. If we exclude taxes and insurance, the monthly payment would be roughly $1,331. If you made all 360 payments, 12 payments a year for 30 years, you would pay back in total approximately $479,000. This would be the original $200,000 plus interest in the amount of $279,000. While this is probably depressing enough, just think how much interest you would have paid if you'd chosen a 40-year loan. The longer the term, the greater the total interest, but the lower the individual monthly payment. Just for kicks, let's look at a 40-year, $200,000 loan with the same terms. It's not a perfect apples-for-apples comparison because the interest rates would be slightly different based on the length of the loan. But how much interest would you pay on a 40-year loan at 7% interest? Your monthly payment, principal and interest, would drop to $1,243, but you'd pay that for 480 payments, 40 payments times 12 payments a year. You'd pay back a total of $596,574. Since the $200,000 loan is the same, the total interest paid back over 40 years would be an astonishing $396,574. In fact, the effort to reduce the monthly payment to make home ownership more achievable resulted in a variety of unique loans being pushed by lenders and chosen by borrowers. Without getting into the prudence of whether a borrower should or should not use certain types of loans, let's explain some different types of loans and when they might be selected. A straight or term loan separates the principal portion of the loan from the interest. The borrower makes interest-only payments, but at a predetermined time, the entire loan amount, the principal, is due in full. One example of this might be a borrower who purchases a home to remodel and flip. Since they need the money to remodel, keeping the monthly payments low is important, so they consent to the interest-only payments for a year, and the entire borrowed amount is due when they sell the home. They, of course, assume they'll fix it up and be able to sell it for a profit within the 1-year time frame. An interest-only loan can be slightly different even though it accomplishes the same low monthly payment. You could have a stronger term loan, say 15 years, that is interest-only for a prescribed period of time, maybe for the first 3 years, before everything is recalculated. Most people opting for this type of financing need to keep the monthly payments low, but would be banking on price appreciation in the future. When they sell, they pay off the entire principal and pocket the equity. A variation of these two approaches is something called a balloon payment. The monthly payment would be higher than an interest-only loan, but lower than an amortized loan. It's what referred to as a partially amortized loan. So at the prescribed period of time, 5 years is the most common for a balloon payment, the borrower would need to pay off the remaining loan balance, as a very small portion of their monthly payment had gone to pay down the principal. It's important to remember that whether the payment just covers interest is not the same thing as whether the interest rate can change over the term. Any loan that has an adjustable rate is generally referred to as an adjustable rate mortgage. The interest rate can go up or down, but the payment has to fluctuate with the interest rate adjustment, or the principal would change as well. It stands to reason if your interest rate goes up and you don't pay a higher payment, then your principal or the amount you owe would be increasing every single month. Adjustable rate mortgages are blamed for many of the foreclosure issues in the country as payments jump beyond borrowers' ability to pay. It's impossible to predict interest rates in the future, but how the loans are adjusted are clearly spelled out in the initial mortgage. It begins with the introductory rate. How long will the first rate remain constant? At a given time period, the loan can be adjusted based on an index. The index can be a Treasury rate yield or the LIBOR rate, the London Interbank Offered Rate. But anyone can know the rate at any given time by opening up any financial news website or newspaper. If you took out a loan 1 year ago and it adjusts every year, then today would be when the adjustment would occur. The lender would look at the index and then add to it their stated margin. As an example, let's assume today the LIBOR rate is 5% and your mortgage states that the lender has a 2% margin. Your rate next year would be 7%, 5 plus 2. There are generally limits or caps on how much a rate can go up or down in any one adjustment period. These are clearly spelled out in the original loan documents, but most lenders use 2% up or down as the limit for any one adjustment period and 6% up or down over the entire life of the loan. If your loan had used the 2-6 parameters, your rate next year couldn't go up more than 2%, and the rate could never go up more than 6% from your original amount, even if rates kept going up every single year. It's easy to generalize and demonize and say people shouldn't have gotten a certain type of loan after the fact. When things go bad, there are plenty of Monday morning quarterbacks, but ultimately, it's the borrower's responsibility to ensure they understand the terms of the agreement. After all, nobody is forcing them to borrow money. It's a voluntary decision. That doesn't mean that lenders don't engage in deceptive practices, because many have, and some will probably continue to do so, because lots of borrowers have a habit of signing on the dotted line without a clear understanding of what they are getting themselves into. That doesn't make them evil or bad people. It just makes it easier for an unscrupulous lender to take advantage of the situation. As Todd Renegade Thornton once wrote, "It's impossible for someone to pull the wool over your eyes if you have already become an expert on wool and can still keep your eyes squarely focused on the behavior of those around you."